Good afternoon. Thank you for tuning in today. I am Tanya Tang, Senior Membership Manager with CFA Society San Francisco. It is my pleasure to welcome you to today's webinar, Private Markets Outlook 2023. A quick note before we start, you will be muted for the duration of the event, so we encourage you to type questions in the Q&A box. We will monitor the questions closely and endeavor to have as many answered as possible. This event will be recorded, which will be shared in the replay. Now, I'd like to introduce Jack Sun. Jack currently serves on the CFA Society San Francisco Membership Programming Advisory Council and will be moderating this afternoon's event. Welcome, Jack.
Thanks, Tanya, and good afternoon, everyone. And it is my pleasure to welcome you all to our event today, the Private Markets Outlook 2023, with our panel of experts with decades of experience in private capital investing, client advisory, and data insights. As we talked about during really our prep call, the last few years have been a dramatic rise in investments in private markets from all sectors of the investment industry, including individuals, asset managers, public funds, endowments, and more. Our panel of experts will reflect on 2022 hot topics, trends, and so forth, as well as provide a fresh look for 2023. They will take a deeper dive into private equity and including a specific focus on venture capital. Just a quick note before we start, everybody will be muted for the event, so we certainly encourage you to type questions in the Q&A box. We will also monitor the questions closely and try to get to as many as possible. And this event, as Tanya mentioned, will be recorded so we can share the replay afterwards. Now, I'd like to introduce our speakers. Tyler Parker, he's a managing director on EQT's private equity technology team here based in San Francisco's office. Mr. Parker joined EQT Partners in May 2022, and previously he worked at Carlyle, where he was part of the technology investing team. Welcome, Tyler. Kenneth Pitman is a principal and director of alternative investments with Mercer's wealth business based in Denver, Colorado. He has experience working with clients on both a traditional advisory and outsourced chief investment officer, OCIO framework, and works with institutional investors, individual families, and wealth management firms to help them implement alternative investment portfolios. Welcome, Kenny. And last but not least, Peter Walker, head of insights for Carta, focused on delivering key data and narratives across the private capital ecosystem. Carta, for those who don't know, is a platform that helps people manage equity, build businesses, and invest in companies of tomorrow. Carta also manages near $2 trillion in equity for nearly 2 million people globally. Welcome, Peter. Now, since we don't have a lot of time, let's just jump right into it. We're at the beginning of 2023. We've seen a dramatic shift in really investments across the entire spectrum in 2022. Right now, and I would like to go to Peter first from your insights. What is the overall market sentiment at the moment? What are you seeing based on your conversations today?
Yeah, thanks a lot, Jack. Just to jump right into it, sentiment among venture capitalists and a lot of the startup founders that we work with is really quite low. Looking at our latest data, which covers up through the end of last year, Q4 of 2022 was the weakest quarter for venture capital investment that we saw on the Carta platform since 2018, which is a big drop. Q4 is traditionally the most prolific and strongest of quarters for both total deals done and venture capital invested. Just to give you a sense of what that looks like, Carta manages the cap table of 33,000 plus venture capital startups. In Q4 of 2021, more than $60 billion was invested into Carta startups. Q4 2022, that was down to 13 billion. So that's a massive drop off. Valuations are down basically, pretty significantly, obviously, for those close to IPO, but also trending down a little bit for even early seed and Series A companies. So I'd be lying if I said the sentiment was anything but a little frazzled at the moment.
Peter, that's very helpful. Maybe Kenny, same question to you.
Yeah, I think I'd start, by identifying what we know and what we think. And, I think the only thing we really know right now is this is a type of period where making forward-looking statements probably won't pay off for the people making forward-looking statements, because there's a lot of volatility. There's a lot of reason to have some level of hope, but there's a lot of reason to be pretty worried too. I would I would echo Peter's comments that sentiment specifically within the venture space seems rather tough right now, despite the fact that we're seeing early stage names continue to hold up from both a valuation and, you know, kind of an outlook perspective. But it seems like there are some people with a view that there's some murkiness on the horizon. More generally, you know, there is a lot of pessimism. And, you know, one interesting piece is we generally see large moves in the market that occur quite differently from where general sentiment is. So that actually gives me a little bit of hope that maybe people are overestimating the downside risk right now, and maybe there's actually some reason to have a, you know, a good amount of hope that either whatever's coming at us will be lighter than expected, or you know, or not happen. But again, you know, they're kind of massive downside risks right now that seem to be impacting people, and I think the consensus generally seems to be you know, to be kind of triangulating around the negative storyline.
Thanks, Kenny. And Tyler, same question for you from a GP's perspective.
Yeah, no, I mean, I echo a lot of the comments that have already been made. You know, people are cautious, generally speaking. And if I think about it from a deal dynamics perspective, stating the obvious that the public equity markets reset last year in a big way. And I think we now see at least the interest rate environment reflected in public company multiples. And private company multiples are correlated, but they tend to lag. So what we saw in the second half of 2022 is just a pronounced bid-ask spread, right, between buyers and sellers in private markets. And deal flow obviously slowed dramatically. You know, if you think about it, higher interest rates pushed up the cost of capital for everyone and corresponding ability to pay. You now compound that with recessionary fears and the financing markets where they are, and you just get really slow deal making. Right. And the IPO markets are basically closed. So you're definitely seeing sponsors, GPs, venture and private equity hold assets longer, particularly if they're strong performers and they don't need to transact. You know, and it's unclear how long that would last from my perspective. We've had 9 months of really depressed activity. There's a ton of dry powder. So my guess is that we'll pick up at some point later in the year. But for now, yeah, it's very, very cautious in terms of deployment.
Jack, if you don't mind my asking Tyler a question, you know, that's the narrative we've been hearing, and you have more ready access to kind of information on the spread between buyers and sellers. Has that been narrowing, or have buyers found maybe structured ways to still transact in a risk managed way with at an elevated valuation, or is kind of the slowness we're all hearing continued?
I've seen it narrow some. It's hard to gauge, but the volumes are still low. It's still very slow based on what I'm seeing. Yeah, there are, and we can talk more about this, but we're seeing more, and I'm speaking mostly about software because that's where I spend all my time. We're seeing more public company activity actually take privates, so going the other way, public to private versus private companies transacting or going public. But no, it still seems to be there. I mean, my gut tells me that, you know, at some point, folks like us will need, and, you know, there's a ton of dry powder and it will compress and people will go back to, you know, maybe it's 17, 18 multiples versus 2021, which I just don't think are coming back.
Tyler, I actually had a question for you on top of that as well. Vis-a-vis dry powder. It's like a consistent topic whenever we're talking to startup founders these days, that the story is, look, there was a ton going to venture capital funds over the last 2 years. They have to deploy that capital in the next 2 or 3 years. Like, don't worry, the flood is coming. I guess internally at Carta, we take a pretty different view to that, in that we expect most of that money to go to existing portfolio companies and not a lot of net new investments. Wondered what your opinion was on the GP side as to where that dry capital ends up flowing once it does start moving.
Yeah, well, I can only speak about it from like the large cap of private equity. I'm not sure about venture as much, but my sense is it will be deployed in private equity. And you know, there's plenty of runway because a lot of it was raised just in the past year or two. But no, my sense is it will be deployed. A lot of new platforms will get done, and you know, we always keep some reserve for M&A, add-on M&A. But yeah, my sense is it will get deployed. It's just a matter of timing. And right now, most of the deployment dollars, at least in software, has been these take privates in the last 6 to 12 months in terms of just absolute dollar volume.
Gotcha.
And that's where I think that's where people see the correction has happened the most, right? It's reflected in the valuations. And so technology buyers that build conviction around some of these low profitability public companies, they see a path to paying premium on a revenue basis and then driving profitability. So
Sorry to sidetrack you there, Jack.
Penny, Peter, I do not mind when you jump in. Appreciate you asking the questions. I think this is what's really helpful when you have these discussions about what organically comes up from your perspectives, and I think that's fantastic. But Tyler, maybe do stay on you for another question, which is relevant to our discussion from our prep call, which is any attributes, particularly specifically right now, that you're looking for in a deal? Has that shifted at all from last year? Have you thought about anything differently? Maybe just help educate us a little bit on that.
Yeah, I don't know that it's, I'll step back. So if I look at the landscape, and I was just hitting on this, public company software revenue multiples, if you look at them on a growth adjusted basis, so, software investors price based on revenue multiples, if you growth adjust those, they are near all-time lows. So I do think there are attractive opportunities out there. And, the stock market impacts overall valuation levels, but we're buying and selling based on conviction and long-term fundamentals. So, we continue to be focused on businesses with attractive market positions. We have conviction on the trends, and then we can also bring the right value creation plan or subject matter expertise. So, I think there are really good themes to invest behind. I think the public situations are interesting. If I think about specific sectors, obviously the CFO is one. There's still a lot of homegrown manual processes that take place where automation can dramatically increase productivity and also lower risk. We actually recently acquired a player in that space in the US. So, I think there are interesting areas to go after. I think we're actually pretty consistent with business quality and what we like, though.
I mean, that's like the positive story, right? That could possibly come out of this is we still haven't seen revenue growth in a lot of the private, and in a lot of the names you're talking about tail off, right, Tyler? Or maybe I'm misspeaking and basing on the June data I have, but it seems like revenue numbers, profitability numbers are staying pat, and if not getting better. And if we can grow through this tumultuous time, like maybe this downside story isn't as bad as everyone makes it out to be.
Yeah, I think it's interesting. There was a ton of 2022 had inflation, supply chain challenges, war, but I think you're right in terms of like the operating performance. If you look at the software peer group, it held up pretty well, right? And if you just look at the corporate earnings, and our portfolio performed well. I do think there could be a lagging effect of some of the changes just in the interest rate and the macro environment.
Mm-hmm.
Real estate, like housing starts to look like they're slowing. Corporate floating rate debt is going up a lot, kind of in real time, and everyone's seen the tech layoffs. So I think the earnings are, they're what we have to monitor going forward. Microsoft was the first of the big ones to report recently. I think it was yesterday or the day before. And I think they took their guidance down a little bit, so that's meaningful. It's like 5% growth guidance, which is okay in the current inflationary environment. So, I think that's something to monitor. Just what happens with guidance? Is it pulled or lowered? Are the earnings beats becoming more narrow, or are they missing? I think that's something that we will definitely monitor. I think everyone will.
Yeah. But like I read a report today, and this isn't Mercer data, so I can't stand behind it. It was just something I read, but I read a report that the CLO market right now is implying something like a 30% bankruptcy rate in that space. And, like regardless of our kind of views, that seems like it might be high, indicating, excessive pessimistic sentiment relative to what's actually going to happen.
Could be. Yeah, we're definitely prepared. We're like internally, I'd say like we're prepared for softness, whether or not it comes to pass, or steep or wide or narrow. But
it seems like it wouldn't be a prudent move not to prepare for that, right? Like if you're over your skis right now in any way on anything from where you live to your career to to how you're forecasting corporate earnings, it seems like the wrong place to be.
Agree.
Kenny, I do want to pivot to you too, from your perspective, working with the type of clients that you cover. I know it's coming up on 7 years for you at Mercer, right? So congratulations, certainly there. You've seen changes, you've seen volatility, you've seen concerns from institutional investors who I also cover as part of my day job. What are you seeing? What are the conversations that really comes to top of mind right now? Maybe just pivoting from a portfolio standpoint to more of an asset allocation standpoint.
Yeah, I mean, so Mercer is a large institutional investor, and we are a process-driven group because we think that that is the way you have to be to kind of drive long-term successful outcomes. When we talk with our clients about their goals, we're not talking about annualized performance. We're talking about meeting their spending goals, making sure that their retirees get their checks, things of that nature. And the vast majority of, those goals at a minimum are 10 years out. And most of them are much further than that. So we generally recommend against brash moves. When we look at pacing within private capital, we generally recommend a pretty consistent approach through the years, regardless of what's happening in the broader economic environment, and maybe recommending some trimming around the edges or adjusting your asset allocation underlying that private capital commitment. But we are generally consistent, and we're trying to maintain that as well. I would say the struggle is making sure that we're communicating with clients effectively who are operating in a fear-based environment right now, so that they can actually make good decisions rather than making emotionally charged decisions. And that is always a struggle in a period like this. But it's the same way that prudence makes sense right now. Not making a brash move and going to cash or something like that also makes a lot of sense. During periods like this, unless you see something that is very actionable and that you see coming, it doesn't make sense to make these huge moves that people often talk about in periods like this.
And Kenny, maybe just to follow up on that, one of the recent portfolio summits that you've done on a panel talked about how private equity and venture capital led the best risk-adjusted returns in alts in 2022. From your perspective, and certainly this isn't an investment advice, but do you expect similar trends to go forward? Will that shift a little bit as we look into the next, call it 12, 24, 36 months?
I mean, see my earlier comments about forward-looking statements. I think we're in a period where valuations in the private space coming down are a potential likelihood, right? Like I'd argue that's probably the more likely event right now. So existing portfolios may experience some softness. If you look at a rolling benchmark, if that means anything in the private space, may not see the greatest numbers, especially if the equity markets are coming off a negative shock and maybe can surprise to the upside. But that doesn't change the fact that could mean that 2023 is the year of opportunity if some of this unwinding happens quicker than we expect, or maybe 2024 becomes a phenomenal opportunity. To what Tyler had mentioned, this year, large cap software names that are publicly traded going private, that's a huge platform investment that's going to drive a lot of positivity down the road. So I don't think I'd make a brash kind of statement saying that privates are going to lead this year. I think we probably are looking at some softness, but that doesn't change the comment about consistency and seeing opportunity down the road. I think there will be a lot of opportunity as things unwind, and investing with a good, strong, active manager too. There's probably what a lot of people are positioning is an industry rotation. If that happens and you invest with a good manager, that's a great opportunity for them, outsized outperformance and things of that nature.
Thanks, Kenny. And Peter, back to you again. With Carta, you're looking at more than 30,000 companies, over 5,000 investment funds, 500,000 employees on cap table management. Anything to reflect on what Kenny and Tyler just talked about, maybe from your really high-level perspective?
Yeah, I think, to Kenny's point about valuations in the private space coming down, certainly we're seeing it across a lot of our startups that if you don't need to fundraise now, you're trying to kind of remain on the sidelines. I'd actually say that's almost certainly not the right approach, given the way that capital is going to be constrained for at least the first half of this year. But when you're talking specifics about valuations, for instance, the median Series D company that we saw on Carta was raising at $1 billion valuation, just over $1 billion in the last quarter of 2021. So 1 out of every 2 Series D companies we saw on the platform was a unicorn. That obviously in this new environment is just not going to continue on. Those valuations have dropped 50, 60%, to be honest, at this point. What's really interesting is what's going to happen to the companies that raised at $1 billion, $2 billion in late 2021. How are they going to grow into those valuations now? Are they going to have access to the capital needed to grow into those, given the lack of $100 million rounds that we're seeing? Are they going to be able to reprice their options so they can keep a hold of their employee talent and retain the key people that are going to get them into those valuations? We honestly haven't seen too many down rounds in the private space yet, but we think that's mostly because managers are doing everything possible to avoid them. So they may be signing convertibles or adding on securities in a different way just to get cash in the door and avoid that down round in a named round. But I do think that more of them are going to happen in the next quarter, 2 quarters, as people really start running out of money. And I'd love to hear Kenny and Tyler's opinion on what I think is the big unlock for all this, which is the IPO market. You know, when are IPOs going to come back into the US space? Because it's just been basically doors closed for the last 6 months, almost a year, actually.
I don't think we're taking a view on that yet, but I will tell you most of the time that we look at capital pacing now, we look at a scenario of delayed distributions to help people understand what it's going to do to their portfolio over the next few years. So I think that's a very real thing that we have to think about. And I don't particularly have a view on when the IPO market will come back. It seems to be a sentiment driven thing that, you know, is a 5 to 7 year cycle or something like that.
Yeah, I don't know that I have a particular view. I think it's not. I mean, at the earliest, I think it's later this year, personally. So I think it's going to be a little while. But yeah, I think you're right, Peter, that everyone's trying to extend their runway. And when you think about alternatives, I mean, you need to segment it by vintage. I really do think, you know, if you look at the data, buyout vintages around recession years tend to do pretty well, right before or during a recession. So there's opportunity out there, I think, for dollars being deployed in the next 12 months, or that were deployed in the last 5-6 months prudently. I do think that capital that was deployed in 20 and 21 probably just has somewhat of an uphill battle, right? Just because the valuation levels were elevated across the board. And some great assets transacted then. And to Peter's point, they'll grow into the valuations, the ones that are winners, right? It'll just take longer. They'll have to hold them longer. The GPs will. But it'll be interesting to watch. I think there will be good opportunities for folks like us.
I think our data sort of proves that out as well. There's definitely a lot of opportunities still out there. One of the interesting points that we've just kind of looked at over the last 2 months or so is back over the year of 2022, we saw pretty elevated M&A across our startup base, which, by the way, it's not, it's SaaS, fintech, health tech, a bunch of different sectors, but I'd say the plurality of companies on Carta do end up in a SaaS model of some kind. So definitely software focused. I think it was the most M&A activity we'd seen across our startups in years. And one of the interesting pieces was a much higher percentage, almost a quarter of the companies that were acquired from Carta cap tables had already raised 100 million or more. So these are established, well capitalized in many cases startups that just found that the strategic acquisition option was a better path forward than trying to grow into this valuation. Any thoughts on, Tyler, I don't know if you said a lot of there's more take privates from the public space. Are you seeing elevated activity or expect more activity on startup to startup purchases as well?
Yeah, it is a category we've talked about internally, just like the VC syndicate, where you got a fragmented board. They have a finite runway. Some of them have really great product market fit, but they raised ahead of their skis, and can somebody come in and clean up the cap table, maybe help them with an M&A agenda with fresh powder, right? Reset the clock. I think it's another area that we're spending time on from a sourcing perspective.
Well, maybe pivoting a little bit here, one of the recent conversations I had with head of ventures investing for a public pension had talked about, and he was joking when he said this, semi-joking, but as far as investing right now for new opportunities, certainly is the best time, Tyler, to your point about looking at recessions. He's also putting on the HR hat. He's putting on the admin hat at the same time as an investor, meaning times are certainly tough. Changes are happening in terms of employment. We've seen massive amount of layoffs. And this is really a question for all three of you. Peter, you're free to jump in as well from your data analytics perspective. How has that shifted in terms of companies hiring, putting on freezes? Has that been what we see in the news? Do you expect worsening outcomes as a result of all the changes right now?
I think it's the story over the last 6 months within our founder community. Two things have been going on. So in Carta data, more people were laid off over November and December than left their jobs voluntarily across our 33,000 startups. That's the first 2-month period that's happened in Carta's whole existence. So it didn't happen even during the peak of COVID. So I think it's not just that layoffs are happening, but it's also that the people that are in their seats right now are not nearly as active towards searching for that next role. They're kind of prioritizing stability over jumping to a different job when they can, which altogether decreases the need for new hires, especially if you're, talking about Series A to Series D startups here. So hiring definitely took a slowdown in the end of the year, and I do think, unfortunately, there's something to the idea that, a layoff today is just kind of not news in the way that a layoff last year would have been. There's just been so many of them that the inundation of it has made it kind of okay in some cases to trim headcount. Whether or not you think that operationally that's the right path to go on, but it is a shame, as you said, because a lot of good talent is losing their jobs. Hopefully a lot of that talent ends up starting companies themselves, but we all know that's not going to be the majority of people that are cut from their jobs today. So
Yeah, no, it's obvious. I mean, it's in all the headlines. There was another one announced today. I think it was SAP. So there's, particularly in tech land, there's a lot of layoffs, and some of the labor market data would say it's overall still relatively healthy, actually, from an unemployment and an open jobs perspective. But from our own portfolio, we're super focused on margin expansion and just operating discipline, right? And I focus on software, like I said. So most of these businesses have really good operating leverage, just given the recurring nature of the cash flows. So most of them can be nicely profitable at scale if they choose to be. So when I talk about efficiency, it's not just about headcount efficiency, but we are super focused on it, as we always are.
All right, that's helpful. Kenny, I don't know if this is relevant for you, but anything that reflects from your conversation with the clients, with board of directors when they see these type of news on their portfolios?
No, I mean, I don't. We have a large talent consulting practice that will have a lot more thoughts on this than I would, and you hear a lot of chatter from them in the tech space indicating that there's a lot happening, but I don't have much value to add there. I think Peter and Tyler did a much better job than I will.
Thanks. Another topic that came to mind as part of our preparation calls is risks, right? So things that we've seen in the news, certainly top three that came to mind was this continued inflation, higher rates staying probably through this year, and changes with the geopolitical risks out there. Is there anything, and really for all three of you, that people haven't talked about that comes to your top of mind that you go, that's something we should really focus on?
Well, considering we have Tyler on the call, I would like to remind everyone that software and technology is still the future of our world. And, these short-term kind of changes don't really impact what's going to happen in 20 to 25 years. Maybe a meaningful interest rate regime shift, which we're probably in the middle of something like that will, but I just wanted to reinforce that software is the future and it's going to continue to be.
Yeah, I mean, I think, another crazy black swan event, right? So nobody wants another pandemic. But no, I think, like, when I think about risk, because we are super focused on the portfolio, just given the environment, like our portfolio construction is pretty good, to Kenny's point. Like we're backing market leaders with enduring tailwinds, and most of our software platforms are mission critical, right? So if I think about some of our portfolio companies for a minute, like most of them are powering their customers' operations. So it's not something a customer can really turn off. One of the recent investments we did was a take private of a business called Bill Trust, which automates the accounts receivable process for its customers. So it's literally embedded in the workflow of how their customers get paid. So it's sticky, has a great ROI. And yes, there's a potential slowdown for new transformational projects and new wins, but I would expect that to get deferred or pushed out at most, right? And retention for these businesses will stay very, very high.
Yeah, I'm not sure that there's any like clear risk factors that are not being priced in for a lot of the startups that we're working with. On the opportunity side, though, flipping this back around, one of the things that we're hearing more and more about when, just to take a point from the labor market discussion beforehand, startups that ended up, kind of coming out of this period pretty okay in terms of cash are really starting to reach for key talent elsewhere. So if you have cash and if you have a good runway, now is the time to kind of pour gas on that fire and maybe poach talent from big tech or other places that you probably wouldn't have had access to 2 years ago. A lot of people are looking, especially on, VP and above kind of levels, to really, really move their leadership teams forward in a way that, especially on the technical talent engineering side, wouldn't have been possible in 2020. So hopefully that kind of those key talents sort of recycle themselves through the startup ecosystem a little bit more closely than they did over the past 2 years, where, big tech was a pretty cushy place to be.
It's a great point. I read an article this week actually about how it's a great opportunity for not like the non-tech sector companies to be hiring tech talent, right? Because there's a lot of world-class engineers, data scientists that have been impacted recently.
Peter, I do want to stay with you for 1 second. I know it's been almost 2 years coming up for you at Carta, so congratulations to that as well. Some of the previous work you've done related to COVID-19 in the crisis there, I think is related to our discussion. And my question is there any lingering impact that you're seeing from that based on your work at the Atlantic, or any data or insights you can share with us?
Yeah, sure. So Jack's referencing some moonlighting I did for the COVID tracking project at the Atlantic, which was basically a nonprofit spun off from the magazine dedicated to tracking COVID throughout the US in 2020 and 2021. Yeah, interesting findings there when we were kind of taking some of that research and porting it over to my work at Carta, startups and everything. I think so, there was an explosion of pandemic stocks, et cetera, in 2020, 2021. A lot of those have come back to earth. Perhaps the sort of typical line that COVID had accelerated the world 10 years towards a more virtual remote future didn't actually prove true in some cases. The one place I think it actually has proven fairly permanent is in remote work and just distributed hiring. Looking at our startups, the youngest startups in our cohorts at Carta, so startups with under 20 employees, say, a much higher percentage of them are hiring outside of state and even out of country than was the case in 2019. So that kind of global look for talent has taken root, at least within Silicon Valley-backed startups. I don't expect that to change. Remote work, I guess we could have a lively debate, I bet, as to whether that's both good or permanent. But looking for distributed talent and kind of hiring the best anywhere, that's definitely a modal that's going to be here to stay for quite some time.
Thanks, Peter. Kenny, Tyler, anything from your perspective or Mercer or EQT when we think about this post-COVID, any effects in terms of your work or your clients' work?
Reinforce Peter. I think a lot of it has gone remote. I'm on the road a lot less than I had been. Candidly, I think personally I'm working a lot more than I was because I'm not commuting any longer and I'm not spending a half hour messing around with people at the office. So I would actually argue that despite some of the narratives out there, employers are probably seeing a net benefit, and we're seeing that with our productivity numbers that have been coming out for some time now. But I think we got to figure out how to keep everyone's mental health high while doing this. And, everyone has an opinion about how this is going to work out, but it's probably going to wind up somewhere in the middle of that. And we're going to have to adapt.
Yeah, no, I generally agree. I think hybrid is the future. I think there are some benefits and intangibles to being co-located and in the office. And I don't know that. I'm sure there will be some companies where it's 5 days a week. I don't think it'll be most. I think it'll be 2 to 3 days in. And echo Kenny's comments around productivity. Feeling the burnout in 2020, 2021. You're basically just always working. And I know a lot of workers felt that same way. And so within our portfolio, it's a blend. We have some companies that are remote first now. I know of two offhand, and they do pretty well. There's certain functions where you might want more in-office time, so development or sales development reps. There's certain functions where you see productivity dip for when they're remote, but for the most part, it's held up quite well, at least for what we've seen.
And I can tell you that Mercer is a huge professional services organization that focuses on HR organizations, and we've had a really good year, in a large part because people are having to find these return to work or hybrid work plans, and so the devil's in the data. People are figuring it out, and we're slowly working through it. Peter, I think I cut you off though.
No worries, Kenny. Just going to add that through Carta's compensation business, which does a lot of salary and equity information for startups. One of the things we are seeing is kind of a employer brand differentiation using remote work as the fulcrum. So a lot of startups are were branding themselves as completely 100% distributed or remote, kind of in the automatic model. That's kind of gone down. And one of the other findings that we're seeing is there was this sense, perhaps at the beginning of the pandemic, that, well, eventually all compensation markets will go national, and a software engineer is going to get paid the same in Seattle as Austin, as LA, as DC. That definitely hasn't happened. The vast majority of startups on our platform, at least, are still geo-adjusting their salaries. Pay is located based on the city that you live in, and it's not the same. There's no national market until you get to the higher sort of leadership levels. So I still think there's a lot of, as Kenny put it, devils in the details on executing remote work and how it affects compensation and all your retention strategies, et cetera.
That's a good point you'll highlighted, and I think a relevant question that came from prior to our call, which was around skill sets. And feel free to chime in on this, all three. But what are some of the valuable technical or even soft skill sets that you think folks should be looking at despite all the layoffs that's happening? I think that's relevant to everybody on this call, and certainly wish everybody the best heading into the rest of the year.
Hindsight's 2020 for me, but I certainly would have taken some coding classes when I was younger.
Echoed, Kenny, echoed. Although I do say that the one thing that has always proven useful to me is SQL. If you're not into coding, but you still like numbers, SQL's your friend. So never a bad time to learn it.
Yeah, I mean, I think in terms of the data, I think developers and engineers, data scientists, those are the ones that are in most demand. So I think those categories will land on their feet. It's still a tough situation, but
That's helpful. I think one of the things I always ask panelists or speakers is we have a pretty diverse group of audiences that dial into our call, and thank you all for doing that. What will be one piece of advice or thing you want our audience to take away from our chat today?
We're talking like investment advice, career advice, life. I'm full of life advice.
Oh, for it. I think it's been so organically that we, you taking the moderating hat from me, which I certainly appreciate for our call. But anything that you want to leave our audience from our call today?
I would just, taking a step back, every Zoom call that I hop on with colleagues and friends and whoever it may be, it starts off with someone being tired, overworked. And I think we all need to take a step back and remember that we have lives outside of work, and think about what we're doing and what we want outside of the time we spend in front of a computer. So that's life advice, not investment advice.
No, that's always helpful. Thank you, Kenny.
Is that legal advice, Kenny? Should I take that?
I'm not sure. Compliance might get me in trouble for that one.
No, that's great advice. I'll deviate a little bit and just and I kind of mentioned this earlier, but the environment is choppy, but I do think there's some really interesting risk-adjusted opportunities out there. for folks with the right operating improvement plan, right? So software, to Kenny's point, has enduring fundamentals. The valuations have really traded off, and it's even more pronounced when you look at the unprofitable SaaS software peer set, which was trading at a premium to the profitable peers just 12 months ago, and they're now, I think it's like a 40% discount. So I think that's what I would leave everyone with. More investing advice.
I think on my side, great time to start a business. One of the things that's really clear is that the further away you get from the turmoil in the publics, the more stable your life seems to be in terms of fundraising, valuations, cash burn, et cetera. So if now is the time to start that idea that you've been thinking about, I can't imagine a better one. The other point is, to the dry powder debate that we kind of kicked things off with a little bit. While I think that there's still some open debate on whether or not that's going to materialize in venture, at least for late stage startups, there's a ton of money sitting around for seed stage. And it kind of feels like all of the majors, your Sequoias and Andreessens, et cetera, have just re-raised big seed funds for the future. So again, I think this is a wonderful time to start a business. If you've already started one, it's maybe a little bit more difficult, but if the idea has been in your head for a while, now might be the moment.
Perfect. We do have questions coming in, so maybe we'll just turn it over to the Q&A. Mindful of everyone's time here. A question that did come in from earlier, which was, let me just make sure I got this right. So what is your thought on corporate investing in technologies in the upcoming year? I think, Tyler, this might be more relevant for you, but feel free to chime in, obviously, Kenny and Peter, if you see anything that's relevant.
Yeah, if it's on IT spend, which I think it is, I expect it to be really strong still, continued growth. It may slow some, and there might be some vendor consolidation, but I think overall IT budgets are resilient and they're going to continue to grow. Software is still a relatively small percent of GDP and has strong ROI payback. So yeah, I expect it to continue to grow nicely.
I think just adding to what Tyler said, I think differentiating between the software sectors will be important. I mean, there's been a lot of money spent on a lot of things that people don't need. They may want. So if you can't just look at software or technology as one thing. They're very different business models, very different focuses, very different use cases, and something like cybersecurity relative to voluntary employer benefits are going to respond differently to what's happening.
Absolutely. Yeah, there will be winners and losers. I think on a net basis, IT spend's going to grow, but Kenny's spot on in terms of like there's different budgets that are going to be more resilient, right? Cyber budget's going to grow. HR is going to be probably constrained. Sales and marketing could be more constrained. So they're not all created equal.
Thank you. Peter, anything to add there before we move to the next question?
Not really. I mean, just speaking as a, employee at a late stage tech startup, we've done a really comprehensive look in all our spend, and we're still going to spend quite a lot of money on IT, various things. Your various project management softwares and all that kind of stuff, definitely more on the chopping block than your key identity solutions, et cetera.
That's helpful. Another question that came in: with private equity firms launching evergreen structured funds to reach retail investors, individual investors, what do you think the risk would be to valuations if we do see a reset in 2023 here?
I'll take it. I'm probably the main fund investor here, so I'll take that. I think there are a couple of different lenses you can look at that. The upside story to valuations are that these open-ended funds are supposed to be democratizing access to alternative investments and private equity. And anytime you have additional money chasing a consistent level of companies or consistent quantity of whatever, valuations are going to increase. So you have that, but you also have some of the risks that we're seeing in the real estate market right now with open-ended structures introducing volatility, or potentially introducing volatility to the market if investors run for the gate. So, a lot of it's kind of dependent on what is happening. I think there's a good story and there's a bad story for valuations with regard to open-ended funds.
That's helpful. Thanks, Kenny. Okay, let me just get through and for the audience, if you have any questions, feel free to put in the chat box below. I just want to make sure I'm covering questions as we go through. Okay, doesn't look like we have any questions, or we already covered them, so that's good. We are coming up on 45-minute mark. Is there anything that we haven't talked about? I know during our prep call, there were a number of resources from all of your companies that folks could get access to, whether it's on the website or a white paper. If you have those, feel free to share that as a follow-up as well. But is there anything that we haven't talked about, Tyler, Peter, Kenny, that you do want to highlight before we end our call today?
Nothing here, not from my perspective.
Yeah,
Thanks for
nothing on my
inviting.
end. Yeah, thank you
Yep.
for having us.
Yeah, this was a great discussion. Appreciate it.
Awesome. Well, again, we'd like to thank Peter, Kenny, and Tyler for sharing all of your thoughtful remarks this afternoon. For our audience members, thanks again for tuning in, whether it's afternoon, evening, or early morning for some of y'all. Certainly appreciate the feedback on today's event. You will get a follow-up survey from Tanya about today's event. Definitely fill this out. We appreciate your thoughts. We appreciate your feedback because that's what helps the advisory council with member programming get better. I also like to thank my volunteers, partners in crime, Steve Biggs, Dominic Bellotti, and Will Brokaw for helping on certainly getting speakers lined up. It's tough times for everybody, but it's one of my favorite quotes. Tough times don't last, tough people do. Certainly look forward to having everyone join us for future events for CFA Society San Francisco, and take care and stay safe.
And thank you,
Back to you,
Jack, for
Tanya.
moderating. Have a great afternoon, everyone.